Welcome to Just Think About It with Nadine and Ben. We're recording this episode on Wednesday, October 30th, 2024. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, X, YouTube, or your platform of choice, and make sure to hit the like button. Second, we appreciate any kind notes and feedback and would appreciate you letting your friends know where to find us. Today, we're going to be delving into the private market landscape with Tyson Hendricksen, the founder and CEO of Notice, a private market data and insights platform. Tyson is a seasoned private market investor himself, as well as an experienced Silicon Valley entrepreneur and FINRA registered broker. Tyson graduated from Stanford a million years ago. Maybe we were in the same class. I don't know. I was about a million years ago, too. And currently resides in Puerto Rico. Welcome, Tyson.
Thank you. Thanks. It's great to be here.
Before we dive into what the data is reflecting right now, Tyson, could you please do our audience a favor and explain why did you found Notice and what was missing from the marketplace?
Sure. Yeah. So I founded Notes about 3 years ago, at the middle of 2021. I had been a private placement broker helping parties buy and sell pre-IPO companies for several years. And at that time, it was just, and even today, it's just it's a really fragmented market. I mean, I think a lot of people think about, the stock market, you have like a few big exchanges and some other, places for liquidity, but it's like pretty centralized. And in our space, in this kind of pre-IPO private placement space, it's the opposite. It's extremely broken up. And that makes it really hard to do really simple things like what's the price of SpaceX right now? Where should I mark my portfolio? Which companies are, large institutions pursuing right now? Where is their liquidity? Like, it's just really, really hard to figure those things out. And so we started Notice. As a broker, I saw people get taken advantage of just because they didn't know what's going on and just all these things that lead to problems. I mean, if you think about it, it's theoretically supposed to be a multi-trillion-dollar asset class, and you can't answer a question as simple as what's the current price, right? Like, this is the problem. And
Price sold, or last few.
totally, is this thing trading? Does the company let transactions happen? What are structures that are reasonable? Who are the brokers I should talk to? What's the process with the company? There's just a million questions. And I was a broker, and so it's my job to call around and figure these things out every day. It's just really hard for me to do the same thing every day. So I figured let's just build something to make it easier, not just for brokers to understand what's going on, and not just for big funds that can pay $20K a year, but for everyone. Everyone should know what their equity is worth, especially employees and folks that are making extremely big, really big decisions on like, do I exercise my options? Do I pay all this money? They're usually the last to know. And that just didn't seem right. So that was kind of the genesis of Notice and the reason that we wanted to start it.
But
when we did.
Don't people love private investments because they don't like the mark to market?
Yeah, actually, yeah, we do. We learned that piece, the mark to market. Yeah. So 2022, when the world was ending, certainly there were a lot of venture funds that would sign up to Notice to use it, but then like kind of want to pretend like they never saw it. Let's leave it marked at the last round price. That sounds a lot better than the current price that Notice is quoting. And so we do run into that sometimes, but I think that at the end of the day, maybe fund managers may not want to know, but certainly LPs want to know what their true exposures and stuff. And so I think there's plenty of people who do actually want to know what's going on. I think at least that's what we're saying.
Back into it, Tyson. One other thing I wanted to ask you before we get into some of these questions is maybe explain to people what type of private investments have you worked on? Are you working on? Just so they get a sense of who you are if they don't know you and the type of deals that you do, because that's a more holistic view of who Tyson is.
Great. Yeah. So, I'm pretty narrowly focused. I got into the space about 10 years ago now, initially because I had friends that I went to school with or were just buddies that started companies. And as liquidity was kind of coming in the private markets and companies were staying private a lot longer, there emerged this kind of secondary market where you could sell your shares before an IPO. And that was just like a really big deal. I think Facebook kind of kicked that off. And so, my involvement's really been around those. So, the Palantirs of the world and SpaceX and these types of companies. And that was kind of where my experience was. But it was really, for me, it was really just helping friends out. And the space is I mentioned kind of fragmented, and there are a lot of bad actors, unfortunately, in the space. I think when you in opaque markets, they sort of attract those types of people. Sometimes they want to get in there and find a way to make a buck. And so apparently, like I just didn't lie. I just told the truth to people, and that made me like an incredible broker. So the bar was extremely low. I was the best ever because people were like, "Wow, you did what you said you were going to do." I was like, "Yeah," and they're like, "You're amazing. Let's keep working together." So, obviously that's the funny joke, but that is not too far from the truth. And so, yeah, so did that, and so those types of companies, so like much later companies, kind of growth stage, pre-IPO stage companies in the venture space. I mean, I know private is a much bigger universe of real estate and credit and all these things, but that's really what we're talking about here is like the venture-backed companies, the ones you see in the news, the really hot ones that a lot of families want to go after, or a lot of funds have been built to kind of pursue these opportunities, to try and capture value before the IPO.
And
Sure.
it's interesting. It's interesting you say that because right around the time of the Facebook IPO, my friend Steve Hendry, who named me, who lives in Marin, had the idea to create a fund in order to buy these pre-IPO 18 months out. And Facebook screwed us because no one wanted to do it anymore because Facebook was such a bad IPO and Zynga was a bad IPO. And I'm very happy that we did have the right idea. Unfortunately, I didn't execute it, but it seems like there's a full infrastructure of that now, right?
There is, yeah. I mean, I think it's interesting. Like, there are definitely a lot of funds doing it, or let's say more than there were when you were talking about. That was a very novel idea. At the time you mentioned. I think there's more funds now, not because they had the great idea, but I think just because there's more investors pursuing that, right? There's more LP interest in those names, the single names. I mean, there's and I think in the public markets, you have these like handful of names that are massively outperforming everything else, and I think in the private markets it's very similar. Like, there's just tons of folks jumping into a very limited number of names, and a lot of the returns are being driven by those big winners. And so, I mean, but there's interesting stuff now too, which we can talk about if you want, like publicly available funds that are holding these private assets. And there's just a lot of stuff going on. I think you look at like something like Destiny XYZ, which has a $50 million NAV, and it like went meme stock when they went public, and it went up to like $1 billion implied whatever, like 20 times NAV, and now it's trading at like 2.5 times NAV. There's like a lot of demand in the general public, I think, for these assets. The best companies have no need to go public, so it's just difficult to access them.
So before we get to some of these questions, I think it would be helpful for you to share your screen and give viewers, because a lot of people do view this, a quick rundown on some of the key features of Notice. I mean, I'm not doing this to give you a commercial. It's more like, I think this site is great, and I want people to know what you track, who's using your site and why, so that when we get into the questions, they understand where we're coming from with the questions. And maybe also talk through, like, if there's some of the most popular features. So again, people get to understand who's using it, why they're using it, versus what might be elsewhere available that they're looking at.
Sure. Okay, great. Yeah, that's great. I'll be really quick. I know this is not a commercial, but it is good to get the.
I wanted people to know, like, we're not here. We're paying for podcasts. I guess which is really more informs the questions and people can
Sure.
what we're talking about.
Yeah, it's interesting because a lot of times when we'll show it to folks, like, it's just kind of like it kind of blows their mind that this information is available. The more that they've been in the space, the more blown away they are, just because they know how this has been really hard to do historically. I can run through a couple quick things. So basic gist is like, we're collecting data from a variety of sources, brokers, funds, and employees, et cetera. And we collect this data. We collect like transaction data, so when trades actually happen, secondary market trades. We collect open buy and sell orders. We collect public Act 40 company, like, Fidelity holds SpaceX. What are they marking it at? We collect all this stuff. Companies raise rounds. We collect that. Companies do tender offers, 409As. Like, we collect all this different information, and then we're looking for a consensus. And, the liquidity, these things don't trade every minute of every day. Here's some SpaceX trades here. And you can kind of see, here's the data points that we're using. And then we're creating an evaluated price based on a whole set of cascading heuristics that look for private market consensus and then fall back on public market comparables. And like, it's like sector comparables, not like SpaceX versus Boeing, like SpaceX versus a very broad basket of like aerospace, right? And so the idea here is for us to be able to create very reliable evaluated pricing for these companies and price them, as public markets move, as private markets move over time. And so that's kind of the very core of what we do. And then we'll layer in stuff on top of that. So tools that kind of make it easier to like, do the jobs you need to do with this information, as well as indexes that will help you understand what the private market might be doing. So this is a 50 company weighted index that looks at 50 of the most actively traded and most in demand names, and creates a weighted composite price of the basket of 50. And it gets,
How do you judge what those are? Is that the largest, just actively traded? It could be
Sure.
smaller. How do you decide that?
Yeah, so our preferences for I think larger and active tend to go together. So like the bigger companies tend to be more active. That's not, I think, a broad rule, a broad kind of generalization, but the main gist we're looking for is companies with private market activity that gives us an idea of where they may be priced. And then we look for the largest. And we have a whole methodology. It's kind of modeled on the triple Q, but yeah, so we do that, and we're kind of reconstituting this thing quarterly, and it goes back, and you can see this is, for example, our full screen. This is our index in the blue line versus the triple Qs in pink.
We'll get to that, the money raising in 2021. We'll come back to that
Sure,
question.
sure.
I think
Yeah, sure.
that's amazing. But the other interesting thing is how it does really match when, especially you're looking here for a 1 year, the Qs.
Sure. Yeah, it's obviously, I think a lot of that too is probably just that like both are being driven a lot by this AI hype cycle. And so it seems reasonable that there would be some similarity there. But yeah, it's kind of fascinating.
And can they transact? Can they transact on your site because you are a broker dealer?
Right. So Notice itself that's a great distinction. So Notice itself is not a marketplace, meaning that we do not facilitate transactions for a couple of reasons. The main reason is because we rely very heavily on our broker partners to contribute data to us.
Yeah.
And so by not being a broker ourselves, we're not competing with them, and they feel comfortable to give us a lot of data. Like we've captured like 1.4 or $1.5 billion in secondary market trade volume in the last 12 months. And that's like 3 or 4 times more trade volume than the largest marketplace.
And
right?
when you say
Because
capture, what do you mean by capture? What can you explain
it's
that?
been contributed to us. Yeah, it's been contributed to us and verified.
Okay.
Yeah, it's been given to us. It's been given to us. Right? That's what I mean by capture. Like we're collecting from our data contributing partners 3 to 4 times more trade volume than even the largest marketplace does on their own. And so by being not a marketplace, we can work with groups that would never give data to us if we were a marketplace because they wouldn't want to empower their, larger rival or whatever, right? So because this market's so fragmented, the largest marketplace is only a tiny fraction of the actual trade volume. And so it's better to like not be a marketplace and like pull from more sources.
Do you then give them business? Do you then
Excuse me?
Like if I go to Notice and I'm looking at this, I'm like, I got a deal. Does it go the other way too, where you're giving them customers potentially?
Yeah. So what we can do is like, what we do is, yeah. So we have brokers that contribute data. Their incentive to contribute data is they get data back, but then also they get ranked. And you can see here are some active brokers in SpaceX recently. And these guys are online and you can just message them and say, hey, I want to buy SpaceX, right? It's a huge incentive for them to participate on the site. And, we also, it's very beneficial if you are looking to participate that you're talking to the right broker. You're not talking to someone who's going to waste your time.
So let me follow up on more. So in essence, I think about TradingView as one of the things that they did was they defragmented all the crypto exchanges, right? And they're like, here, we're going to have, because the main guys didn't have it. So you go look up crypto prices at random coins like, Shiba Inu coin. And so you have that component, but then you also have like a Zillow component, right? So Zillow TradingView a little bit.
Yeah. It's funny because people ask like, oh, are you like the Bloomberg of the private markets? And my answer is no. I think we're a lot more like the Zillow of the private markets. We're trying to create the MLS, right? They got to just integrate existing MLSs. That was nice for them. We have to create it. Right. And then we want to put forward brokers that might be experts in certain neighborhoods, which in this case would be companies. so that you don't waste your time talking to someone who doesn't have the specific knowledge
All right. So
necessary
there's a
to try to.
flywheel then, basically. Like your brokers give you the data, you can give them the customers and the notoriety, and okay, I could see it.
Yeah. So that's the idea. So instead of like, hey, we're a marketplace, we're going to try and keep you at arm's length and, really we're trying to promote these folks yeah, it's a content flywheel is what we built.
Yeah, very cool. Very cool.
Thanks.
Maybe we go and say, what do you think about those private marketplaces? Like, NASDAQ has one, tier 1, tier 0 or whatever. I mean, I've seen a couple of them. Do you think those things are going to work? Or do you think that it's just like everybody thought they should do it, but then didn't think about the business side of it that much?
It's an interesting question. Like, I don't want to speak out of turn because I know a lot of these guys. So I don't, there's no like,
Sorry.
no, it's okay. I'll tell you my thoughts. I know these guys and they're great. Again, they're not competitive really with us. So it's not like it's trying to diss them or anything, but I guess the question could be framed as, why else would you not be a marketplace? Like, why not? That's a legitimate monetization model. Why wouldn't you go do that? And I think for us, like, I don't know of any marketplaces, and there's like at least 10 that are profitable. Okay. I don't know of any that are profitable. Maybe one is like break even profitable, right? Like maybe one, but like most of them are not. I mean, Forge is one of the biggest and they're publicly traded. You can see their financials. They lose tons of money. And I think there's just something to the idea of when you create a marketplace and you create this transparency, it tends to skew towards like retail size transactions. So much smaller transactions where you then have an extra operational layer you have to layer in around like, well, we have a bunch of people who want to buy 10K of OpenAI. You can't do that. So we're going to create an SPV, which means we need to have like a back office to do that. And then now you're spinning through a lot more smaller transactions, making lower revenue per transaction, obviously. And it comes with an increased cost. Not only that, but then you've got to create this tech platform and maintain it. So you have an R&D cost you've got to carry, et cetera, et cetera. And it doesn't seem like there's really been anyone who's been able to like crack the nut on like, well, when we get big, then we'll be profitable, because it seems like the labor costs and expenses kind of scale more linearly with revenue. And that just makes it trickier to like get a true tech outcome, because this is more like buying a house. You're like doing escrows and signing documents, and DocuSigns are going around, and like LPAs and all this stuff. It's not like I click to purchase shares on E-Trade. It's not like that. And so it's just really, really hard to build that. Do I think they'll be successful? Maybe they will. Maybe there'll be a roll up. Maybe someone will crack the nut on it. But, I don't know. We'll have to see.
So Tyson, can you go back to your index, the inception to chart? I want to look back at the inception to date, not just the year to date per se.
Sure.
So, a lot of money was, let's max that up,
Yeah.
because I've gotten so interesting there, right? That a lot of money was put to work back in 2021 at arguably very rich valuations, right? And a key difference between public and private markets is a lack of transparency in valuations, which you mentioned, transactions, including the mark to market. So maybe you could walk through some of the data over time in terms of capital raised, invested, valuation, so people get a sense of the trends that have been going on and where we are today.
Great. Yeah. So we started this index in 2020, mid 2020. Okay. That's when the data goes back to. That was at 1,000. At the peak, it peaked at a little over 3x that, right? So we're talking about a year and a half later, 3x increase in the index. Pretty crazy. I think that there's a couple ways to look at this, right? So one of the first ways is if we go here to the total trade volume collected by us, you can see this is 2021, and this, there's some similarity here between trade volume that we've collected and like the index price, right? And so clearly when there's a lot more trade activity, a lot more buy side, it's pushing prices up, and it's just general interest in this asset class. And then, 2022 is like the depth of despair. And now we've got it with AI, it's sort of driving some larger transactions and things are sort of coming back to life. So I think one thing you can look at is that. Another thing you can look at is you could say, okay, 2021 at the peak, there were something like 1,300 unicorns, right? These billion-dollar companies. And people will talk about this a lot. They'll say, oh, there's 1,300 unicorns. There's not 1,300 unicorns, okay? There were at one time, theoretically, 1,300 unicorns. There are no longer, right? And so, now if you look at this, I don't even know what the number is, but if I go here and I say, give me, all companies with a market cap of $1 billion, we have 367. Okay. So are we missing a few? Possibly, but it's way down. Okay. It's way, way down. And it's way down for a couple of reasons. Either A, they've raised down rounds. They just said, hey, we got a little over our skis, down round, no problem. Let's just reset expectations and move forward. Or they've had secondary market activity where sellers are like, hey, I'll take 1/3 the price that we raised our last round at, right? And they've done that. Or there's just been tons of pressure on the sector. And even if there isn't secondary market activity, we think that clearly this company is worth a lot less than it was at the peak. And so, maybe there's 1,000 companies that were unicorns that aren't anymore. I don't know what you call that, a unicorn die-off or something. I'm not sure. These people with the news media, they love these things, but that's the situation. So you kind of see this big thing, and we've also seen a concentration. So in 2021, I don't remember the exact numbers. I wish I'd prepared better on that. But basically in 2021, there's just a much broader spectrum of companies that were kind of on the radar for investors, for buyers in the space. And a lot of that was the crossover funds, the Tigers of the world and stuff that were kind of indiscriminately, hey, I want to buy the market. I want to own 5% of this entire asset class kind of thing. And that would drive other activities. So there was certainly that. And now the volumes are coming back, but it's a much narrower band of companies. And we were joking before we started the call, but pretty much a lot of them have AI in their name, right? So it's a very concentrated thing that's driving this kind of new wave. Obviously SpaceX is there, and Anduril, and some of the big Tyson Hendricksen and Stripe and Databricks. These are great companies that have been around for a while, but a lot of the new stuff is being much more narrowly focused. And people seem to be kind of more herd mentality around that. So the volumes are back, but it's very concentrated.
And
you think about that 2021 period, we had the SPACs also, right? So there's some of these guys, for example, Nadine and I recently had the head of engineering from Joby Aviation on the podcast a couple of weeks ago. And, Archer and Joby go public, and they're way too early to be public, right? So there was a bunch of companies that actually snuck into the public markets, would be in this, morass of 1,300 formerly known unicorns that are somehow just waiting around in the public markets. Do you look at those as comps relative to your base? Because they are kind of Joby's 5 to 10 years before it's a real business at this point.
Yeah, we do look at the public markets. We look at IPOs. We take that into account. We have this IPO tracker of companies that have filed, companies that are expected, and then we'll look at companies that have gone out, and look at their performance as well. A lot of them are, there aren't a lot of great parallels often between these companies. I mean, I think generally it's helpful, but one of the things that we will do that might be kind of cool is to talk about is, when you look at a company that IPOs like an Instacart, usually this is right where you start tracking the stuff, right? It's public, and then you have a stock chart that starts on this date. But, when you can combine the private market data with the public market data, you get a much more holistic picture of this is what it was doing going in the IPO, and here's what it's done since then. And so that can be helpful for people. For example, I don't know what's a good example. I don't know, looking at companies and saying, oh, well, at what point does this, do the investors in round D, what point do they become, marked up, and will that create selling pressure in the public markets? And just trying to understand where people may have been holding these assets. And so we do have tools that help people to look at that, but we're not saying, oh, how well is Joby doing? Not so well or very well, therefore these other companies should be handled that way. So
what about Coinbase, for example? Because the Coinbase did a famous IPO where they issued a ton of stock. The normal process for IPO is the underwriter float 15%, to try and get its legs in the public market and not like let short sellers just crush it. And, it's well placed with guys who are involved with the story. And so Coinbase comes out and it was the highest price it's ever traded at was the first trade. And that's usually a bad deal when you have the first trade. I've done a lot of IPOs in my day. Usually if you have the first trade as your worst trade, or even worse, the deal price was your worst trade, you know who won the transaction, right? And so your service is very interesting for that. So can we see the Coinbase prior to
Yeah,
the
Coinbase,
IPO?
we don't have a lot going back. We have,
Okay.
there wasn't a lot of trading activity in that name leading up. Either the issuer was blocking it or I'm not sure. But yeah, we don't have a lot in that name, unfortunately. So
What
we
about
can't really look at that one.
Palantir? Palantir was
Palantir?
another one who did an IPO that was, hey, we're going to sell all our stock early.
Yeah,
And
Palantir.
you had that actually bought the stock. I remember it had
Yeah,
that period where there was guys selling, and then
right.
one day the market decided they liked collections of smart guys.
Yeah, it turns out that data and smart people with software is something worth looking at. Yeah, there were definitely transactions here. You have transactions here and below $5. $8.6 billion implied valuation, kind of leading up to the year before the IPO, and then there's a pop,
Well,
and
that's
then of course, as you
interesting.
said, what,
So you
what?
could have seen that, hey, we're actually getting this at a discount relative to where it was traded in the private markets.
Exactly. Yeah, there are trades happening at $9, and then it goes out at whatever this is, 9.20 or something. It's like, well, you know, maybe this is a good deal. So yeah, I mean, and you can of course see like this is where BlackRock was marking it at 636 with information rights and et cetera. And so you're thinking, hey, maybe there's something here. Yeah, there are things to do. I mean, obviously IPOs the window has been like kind of cracked, but mostly closed for a lot of these companies. So we don't have a ton of examples of like, and here are 10 companies that went out,
Yeah.
and here's where they are. There's just a handful that have kind of made it.
Can we get back to one of the questions that Ben brought up about just talking about the various constituents, right? About why they're not incented to mark investment valuations down?
Yeah.
Lots of them are incented to mark it up, but not down. So from the perspective of company management teams, the GPs, the LPs, even the lenders, right? Like there's different folks out there who get this data. Like obviously it exists. They could also look at the public markets and do some sort of valuation discount, but often don't, or at least kick the can down the road until they're either forced to or it's too embarrassing or compliance reason. So maybe you could talk a little bit about like why does this occur? Because some folks like you who are really knowledgeable about private markets get it, but there's a lot of people out there who may not, and especially employees, that have stock of a company that has not gone public. Why is this happening?
Yeah, it's interesting, right? So there are a lot of incentives out there that are some cases aligned, some cases not, right? So let's just start with the issuers, right? So the issuers oftentimes do not want this information to be broadly available. They oftentimes do not like the secondary market. Okay. Um, the main reason they don't like the secondary market is that it can, if they're in the middle of a fundraise, it can create noise for their fundraise, right? So I'm raising at $10 a share and there's X employees in the market dumping at $5 a share. Not great for my negotiating leverage in the conversation, right? Hey, ignore that. Let's look over here, Not only that, but those shares that are out there compete with my shares, right? So, hey, I love the company. Thanks for the deck and taking all the time. I'm going to go over here and get it for half the price. Have a nice day, right? That's not great either.
Yeah, you're
Yeah,
telling me the bankers don't like you taking their information asymmetry away from them? Is that what you're saying?
exactly. It's not their favorite thing. They love it. So yeah, so that can cause problems. And there's like legitimate concerns too, right? Like if you are, you know, if you're a company, you also have an incentive to mark down your common, right? You want to have the very low 9A mark for your common because that creates a bigger delta of value for your employees that receive those stock options, right? So you want to raise your preferred the highest price, and you want your common to be worth as little as possible, so that you can kind of build in this nice thing for them. If there's a bunch of transaction activity of common trading, then maybe your auditor or your valuation services firm or somebody says, hey, you've been marketing it at a penny, but it's trading for $3. This is a problem, And so there are like that's like the most legitimate thing I think you could have out there. But like a lot of it's really just, I'm the founder. I took some money off in the funding round, so I'm okay. Don't cause problems for the company over here, please. There's other issues though too. Like there's companies where if the company's doing very, very poorly and is maybe worth less than in the money they've raised. So I raised $1 billion. I raised $1 billion. If I'm not worth at least $1 billion, that means my common shareholders, i.e. all of my employees, are wiped out completely, right? So like, do I really love it if all my employees know that their stock is worthless? Like, probably not. It's going to hurt recruiting, And so there's other reasons where, and maybe you think, hey, this is a temporary blip. Things are down, but they're going to turn around, and I don't want people to lose the faith. And maybe there are cases we've seen where, there's a company Thrasio, which was, kind of like a roll-up of Amazon stores, whatever. And I knew someone who was a very early employee there and leaving, and basically had scraped together a little bit of money on like a very depressed salary, right? Because they were getting options, save together a little bit of money. And on the way out, when they were leaving, they were going to take all of their savings and exercise their options in Thrasio and then pay the estimated taxes on that.
Right.
And you look at our site and it's like, Thrasio would have had a 10x for him to make a penny. So so what's interesting is like by being a CEO and not telling your employee who's leaving and giving you $50,000, right? Here's 50 grand for worthless stock.
Yeah.
And you say nothing. It seems fraudulent. It's not, but it's like really, really weird. And so, but like at the same time, you can't say, hey man, I wouldn't exercise those. They're worthless. You can't say that either. So you're in this weird situation. So by having this third party site, clicking all this information, it's like, well, make your own judgment, but and so I think that's just, there are massive information asymmetry with employees for sure, with investors for sure. And so pulling all this together kind of helps everyone make better decisions.
Interestingly, we had it was a kind of pre-podcast talk with a good friend of mine in PE. So much later stage, obviously, but he was also just talking from the lender's standpoint, right? So obviously GPs don't want to mark it down because they're getting fees and they want investors to be happy, the LPs to be happy. But then you have this situation where and the LPs don't want it because they don't want to look like they had terrible returns. They might lose their job if they're in charge of this portfolio. But the lenders, they want to keep that loan out there. They don't want to have problems in their portfolio and deal with their superiors or have to put restrictions on, which could happen if the valuation went down. And they're hoping, if rates go down, then we won't have this problem because, we'll figure that out later. So it's interesting that you're talking about from the management teams, the employees. There's a lot of constituents here, viewers who may be aligned to do things, might not be the best thing going on for folks on the other side of it, but it makes sense why a lot of people don't want to have transparency. So things.
You're absolutely right. GPs and LPs are oftentimes aligned around that. What you said is 100% what we see in this market as well. With these being liquid assets, right? Mostly liquid assets, like the rules allow for this, right? They allow for very broad interpretations of valuation. And anyway, yeah, it's difficult. It's difficult to know what's going on if you're relying only on your GP reports. Like, pretty hard.
And so, when we're thinking about your business model, you have the content side of it. Is there any, like, maybe just what do you vision it, like, where is the success scenario and where in like 3-5 years, whatever the timeline is, of where this can go for you, like being the standard, aggregating, and I'll let you answer. It's your business.
Yeah, no, sure. So I think for us, like, data is the goal, right? We want to collect data. We structure our business to do that. We have aligned incentives with the people who are sharing data with us. We handle the data in a certain way. We verify it to the highest standards. We do all that stuff. I think that there are quite a few ways to go with it, right? So there's obviously data licensing for people who are very active and want to know all the details of what's happening, kind of like level 2 quotes. There you go. That's what we're currently doing. We have paid plans for that. We have big financial services companies that are like generating index for asset managers to track a tradable index of 10 or 20 of these private companies. So we'll be powering those. We already are powering one. We can't announce yet, but it'll be announced soon. And I think that think that, if we can collect more and more of this kind of order flow and buyers and sellers, et cetera, and just put them in touch with the right service providers, whether that's brokers to help them transact. Maybe there's opportunity to kind of monetize that interaction. There's lenders and like structured guys, like funds that are doing structured deals with employees and things. I think we can help with that. And then I think we need to kind of help syndicate this data out to other platforms, right? So why is it that I have to go to Forge to enter my indication that I want to buy or sell? And then I have to go to Hive, and I have to go to Equities, and I have to go to Augment Market, I have to go to Gondola Market. Like there's 10 of them, right? Like if I'm looking to sell or buy, like I want to know that I'm seeing everything, and I can't see everything in one place, and it's kind of tricky to manage all that. So you end up with a bunch of stale data, stuff that's like no longer actionable. If we can become kind of more and more of this source of data for the rest of the market, then I think that positions us to like help alleviate some of the problems in the market, and then also could open up monetization opportunities there as well.
Would you see a scenario where I can pull you up on my Bloomberg?
I don't see why not.
Yeah,
I
right.
don't see why
why not? Like,
Yeah.
I mean, you want time series and
Yes.
public market
Totally.
investors, and then you can integrate all the analytics that are on the terminal, get access to it, and you can get paid handsomely for it.
He's already creating the solution here. He's excited. I said you're already creating the solution here. You're excited.
I just think as a guy who's done a lot of IPOs, I think it's a fantastic thing. I think it's good for people to have a sense of, even if it's thinly traded or it's here of like, what's the trend been, right? Like, is this thing rising, falling,
Where the insiders have been at, like the VC versus others. And actually, you mentioned something, Tyson. If you could go back to that sort, you track companies that are worth less than the money they raised. And that's
Yes.
really what to talk about, right? So could
Yes.
you elaborate on the
Sure.
numbers of these companies? I'm not here to dig on anyone in particular.
Sure.
Just a number of these companies, how people would see that, and the total capital we're talking about, and any other numbers that you would share.
Yeah, so we there's ways to do this in our screener. It's a little bit complicated to get all the filters in there. One of the things that we do to make it simple for folks is we have this rankings list. A lot of our rankings are like rankings that you would want your company, like most valuable, whatever, most active, most whatever, popular. This is
changes in others. I get it.
Yeah, exactly. This one is riskiest common stock. We couldn't really figure out what to call it. It's kind of a long title, but basically these are companies where if you own common stock, it's extremely risky. And it's a very basic analysis, which is basically let's look at the total amount of money that's been raised and let's look at what the company's currently worth and divide that. If it's less than 1, then common's probably worth nothing. It's a very simplistic view. It doesn't take into account investor permission, privileges and rights and all these things. But it's a very simple thing. And, there's some companies on here, GoPuff, be careful, like there's some names in here that people will, Rappi, just watch out, just if you're an employee, be careful. If you're looking to transact, be careful kind of thing. But yeah, that's like the simplest way to do it. And then we have like pretty advanced stuff that we do around like looking at the actual waterfall. So let's look at the actual investor. Let's look at those investor rights and let's look at what every class of stock would get at every different possible exit values, at a $3.75 billion exit valuation. This is where we think it is right now. Common's worth nothing at this point. So, you don't have to take our word for it. You can go in here and make your own, hey, I think it's actually worth 2.6 billion, whatever, put in debt, do things, change the outstanding shares and just recalculate it. So to fully like productize waterfall to kind of better understand a specific company versus like, hey, here's a list of companies to be careful about. It's actually interesting because we did a couple articles with TechCrunch and a few other folks over the last year or so, and like I've really been trying so hard to get someone to talk about the story of like companies. Like we think there's 58,000 employees that work at the 50 riskiest companies for common stock, all of which we think are worth less than the money raised. 58,000 employees. So aggregate market cap 18.6 billion, total funding 38 billion, right? So, but no one will write this story like, hey, by the way, there are a lot of people that are really screwed here.
What are they talking about? So I think this is just absolutely fascinating.
Yeah, I mean, I think they'll talk about it in general, like, oh, hey, those 2021 valuations sound kind of crazy. great. And that's the end of it. It's like, well, what are the ramifications? Like, okay, what if they are crazy? What does that mean for these really educated, really motivated people that maybe it would be more efficient for them to be working at a company that is actually, doing stuff and going places versus this thing here. Like,
Can you
they
see
don't know.
capital firm? Which ones have the most of those?
It's a great, I mean, we,
Pie chart, right? Who's holding the bag?
What?
yeah, I don't
And
want
are those big holders marking at the old ones still? Are they fiending at those old marks?
So it's a good question, right? Like, I don't know if they are or not. I only know the marks of the public funds. So like Fidelity, T. Rowe, these guys that own this stuff, I know where they're marking it because they have to file that with the SEC. It's a good question. I think that a lot of the big guys that it's been known that they like, Tigers of the world that did, whatever 300 investments, like my guess is they've marked them down just because like everyone's like, hey man, but if you have a portfolio where like maybe the fund is reliant on like one or two really big winners, are you going to mark those down? Maybe not. Like maybe you leave one of them where they were and you just say, hey, as far as we can tell, this is still the price. So, I just,
So maybe
yeah,
those are the guys who are shutting down your story.
Yeah.
I don't know. Yeah. So the story, like, I don't understand. Totally. I don't understand why. I'm like, listen, this is like, I could do a deeper dive. It's probably 100,000 employees working at not startups like tiny startups like ours, but like at a big company with a big office in San Francisco with like lunches and like, shuttles and stuff. And like, they're like, I'm safe. It's like, no, you're not safe.
You're
Like,
the opposite. You're the
don't
opposite.
exercise your options, man. Like, and they don't know. And so I don't know.
Yeah.
No one wants to write the story. So maybe someone will.
At that story, Tyson.
Okay,
I'll write
let's
the
do it.
story.
Let's do it.
To sort by the investors. Are there any firms and funds that are completely holding the bag? Right? Do you see a
Great
pattern
question.
in those? And I think that pie chart is also interesting, maybe to a different set of constituents, but both of the things are really important.
Nadine, be
Sure.
careful. You live in the valley.
Yeah, right? Because if you're going to toil away for the next 2 to 4 years as an
Yeah,
employee, wouldn't
totally.
you want to be able to make sure that it's, the bang is worth the buck or the juice is worth the squeeze or whatever saying you want to use, right?
I mean, it's just more efficient, right? Like companies that are doing very well should attract the best talent and get these people. And then companies that aren't doing super well should like lose people. It just will be more efficient that way. But yeah, anyways, that's definitely happening. A lot of this adjustment has kind of been starting to play out and people are doing down. At first, it's like, ooh, down rounds. So that's such a bad word. Like I remember when Klarna, I had this other second ago, but when Klarna did their big down round, which is a while ago now, when was it? Mid 2022, it was like, oh my God, Klarna did this huge down round, and since then they're way up. And so, but you mentioned the insiders, Nadine, and like, what's interesting is if you look at this chart, and this is why I think it's fascinating. Like when you look at this chart, these are large. So there's trades happening up here at, what's that?
Looks like they knew sales.
They knew. Yeah. So these are like trades at $1,600 and you have sellers here, like, and then all of a sudden they're like, I'm a seller, but I'll take like, half the price. And you're like, what? And so our algorithm sees this consensus, starts to price it down, and then the news of the round drop, at $200 a share. And so certainly there are insiders, certainly there are known folks that know what's going on, and they're trying to kind of get out there ahead of the news.
Are they allowed to trade? Because it's in some ways inside information. I mean, are they
Sure.
allowed to? Are there the same kind of restrictions?
Yeah, so it's interesting, right? Like I asked my mentor when I first joined the business, like joined the broker, like what is inside information in our space? Everything's private. Like what's going on? And it's a ton of gray area. But the rule that I used was if I have information that other information rights holders do not have, then it is not public. If I have information that all the information rights holders have, then it's like okay to use that information, right?
Is that you, or is that SEC? Well, what are we talking about here?
That's me. That's my own interpretation. That's the rule that I lived by as a broker. Okay.
Standpoint.
Right. SEC standpoint. super murky. I know investors that are on boards that trade news from board meetings before it gets sent out to the rest
Yeah,
of the investors, right? I know that. And they obviously have advice from probably very expensive lawyers that say it's okay, just be careful,
sure.
is my guess. I stayed as far away from that line as I could, but like there's definitely stuff that goes on, but I don't think it's technically illegal. I think it's technically okay, which again is a reason why something like this is helpful. You know, you're out there trying to buy it at $1,600, and then you don't know that there's even sellers at 800, and should that be a concern? And so, yeah, it's just it's not
Professional accredited investors, right? So you're not protected at the same level in the private markets as you are in the public markets. And one other analogy to go back to crypto, in 2021, me and a guy, we started aggregating when these lockups would come up. Like, and then what now?
yeah.
Now there's a company called DeFi Llama that has them, and now they kind of did what you did, starting to aggregate it. Back then, we had to go like one by one, and we would look at their lockup table. So technically, it was out there, but like, you had to do some work, and it was a huge competitive advantage because we just shorted those things. And as the lockups would come up. So I think that there's not a lot of, it's a little very different, Nadine, in the private markets.
For sure. No, I know that, but I just wanted to know, like, you see this and it looks criminal.
Sure. Yeah, it does. I mean, and like I said, I think it's just like levels of risk. What are you willing to? The private markets, it is kind of buyer beware, and this is the Wild West.
Yeah, exactly. If you're going to play in the Wild West, know that you better come with a gun, right?
Yeah, it's not a knife fight. It's not a knife fight. It's definitely a
Exactly.
gunfight.
And so as we think about this, like just a final bow tie this thing with this huge mass of these guys, are some of them just going to evaporate? Or, how do you incentivize employees when all their, like a huge part of their comp is gone? And it doesn't seem likely, especially with us sitting at the all-time highs in the S&P, if they're not even close to back to where they were in that era, unless we go full Ponzi, in the markets, how they could ever get back to where they need to be. Do you restrike it and then dilute people, or how does
I
it
think
even?
that's what companies are doing. I mean, look, not all companies are struggling, right? Some companies are doing extremely well. In fact, I had a call last week with an issuer that contacted me, um, which is rare. I thought when we did notice they were all going to hate us and try to shut us down and all this stuff. And like, we have more issuers that pay for our pro data than we have issuers that complain about our stuff. Like, I don't know why they don't complain. I don't know. But this issuer was complaining because they're doing very, very well and we didn't know. And so they wanted us to know how well they were doing because it was hurting their recruiting. And, we have like between 100 and 200,000 people a month that use Notice, right? So it's like a pretty good chunk of people that are checking it out. And it was like crushing their recruiting efforts. And like, he was very annoyed by that. And so I think that like getting the information out will help. I think there are companies that are doing very, very well. There's companies that are repricing these things down and kind of reissuing options and doing stuff there. And I think there's also a class of companies that are, and so there's so many companies maybe in 2021, they raised at a high valuation, but they're a real business. So they just got ahead of themselves, right? And they're growing into it. It's painful and like, but they're getting there. Some companies, they weren't real businesses, right? They weren't real businesses and they've cut their teams and they've done all this stuff. And I think those companies are zombies. I think they're just going to go on for as long as they can. Every organization, every animal wants to live. They're an entity into themselves. And so they're going to try to live as long as they can. But I don't know. It's like hard to know what percentage is zombie versus just ahead of it.
But it sounds, I think this is great. So you're basically shining a light in a dark area, and the guys who've been taking advantage of being the, Plato's one-eyed man in the blind cave are not liking that this flashlight's coming in and taking away some of their margin or edge, if you will.
Yeah, there's definitely some of that. I mean, I think, but what's funny is a lot of those people that have information, they use it too, because they have information, 3 companies, but there's 10 more they're interested in and they don't know anything about them. So, I think that, as we all know, I think we would all agree, like leveling the playing field for information benefits everyone. Of course, some people lose a little bit more than others, but like the net positive is just massive, right? Like you want this to be a real asset class. people need to know what things are worth. They need to know
Right.
what's happening in the market. They can't figure that out, then it's just never going to be real.
Yeah, transparency always wins, for sure.
To kind of a final area here is that there's obviously been huge trends of large mega financial institutions starting to sell privates to more retail, high net worth individual clients. So you kind of, they're tapping into this space. Every wealth manager is hawking stuff. What are your thoughts on that trend? And is that going to just be providing more data to you, or do you think that's a good thing? If a lot of people, even sophisticated people, didn't really understand what they're doing, opening that up to people who arguably have less sophistication, at least I'm a little bit concerned about that. I know it's a fee generation for some people, but what do you think about this?
Yeah, I mean, it's concerning. I think what's tough is in the absence of, like, we have some data, but we don't have full information. I don't have financials in these companies. Like, we're looking at the other end, like trying to look at the keyhole and figure out what's going on in there, right? And so even with these tools, it can be difficult to know how the company's doing, right? You're kind of hoping that those who are transacting are informed, and then you're sort of leveraging their informed best guess on price to kind of set your own expectations, which is very derivative in nature, obviously.
And Tyson, so part of the marketing has been, look how stable these returns and good the returns are. But it's because of the issue you're solving, which is that there's lack of transparency. Like they would have been a lot more volatile, right?
Sure. Absolutely. Yeah.
Transparency, and maybe they would feel less safe about these investments, and or I guess have a realistic evaluation of what the potential return would be. You had Cart on there as a good example. I think a lot of people had great expectations, but after the IPO, it wasn't, for some, not the best return for them. So I put that lens on as well.
I think that I've talked to a lot of family offices, and I think there's a lot of demand for the asset class. For some reason, a lot of folks just want they want to chase alpha. They want the next big tech company before it blows up in the public markets. I think there are opportunities to make money. There are definitely opportunities to get great returns. In terms of like people hawking a bunch of stuff, I just think that a lot of those returns are going to be concentrated in like a handful of names. And if you've never heard of it before, like, be careful. And if you have heard of it, then just decide if it's for you or not, and try and figure out the price is right. I mean, really, if it's a great company, is the price right? If it's something you never heard of before, just be careful. And and the other thing to think about too, I think, is just that, like, these companies are doing great, and like not a lot of them are IPOing. So like you may be holding this for a very, very, very long time. And I would say, I think there's that that's happening. There's also these private indexes that are happening, where they're going to have these big indexes. They're going to try and bring billions of dollars of assets onto these indexes that are holding these private companies. That creates just like an underlying bid. Like, oh, I have to balance up. I got to buy more SpaceX at whatever the price is. I don't care. I'm a buyer of $100 million of SpaceX. And so I think that's going to create interesting kind of distortions and stuff as well. I don't know if it's necessarily going to create efficiency. There's like a lot that's going on here, but it's definitely an interesting asset class. I think having liquidity available to employees, to early investors, especially these companies be private for 15 years, that's great. Like, there needs to be something. I think it's helpful for price discovery for next funding rounds. I think it's helpful for price discovery for the IPO eventually. So I think it's net very, very good. I just think there needs to be a lot more transparency in this stuff, and all the players need to really understand what's happening.
Do you think as you bring transparency to this area, and it's clear that like there's a lot of margin, or there was a lot of margin until, obviously things went awry in 22, that maybe the equity market always likes growth. If you go back to the .com, not the .ai, the .com, there was all kinds of young growth stories, and that Joby reminded me that in the public. I just, you don't see as many of those, and the SPACs are how they got in, and that sucks because SPACs are terrible structures. Do you think there's a chance you could go reverse the trend of, like, let's be private forever, to maybe let's take our hand in the equity markets where they love growth? Do you think that could reverse?
Yeah, I was in a podcast a few days ago where I was arguing that if I was running like a buzzy AI company that wasn't OpenAI or something, but like it was like a buzzy AI company, I was getting like early traction, but like, hey, I might not win this. Like I got some really big, deep talkative competitors. Like, why not go public and just capitalize on like the massive feeding frenzy? Like,
Yeah.
I mean, obviously the biggest guys don't need to. They're going to get, $10 billion whenever they need it. So who cares? And, they don't have to worry about the next quarter, right? Like, why wouldn't these guys go out? And I just think that, especially for the AI companies right now, like capital doesn't seem to be a huge problem for them right now. So I don't know that there's a lot of incentive to go out and do that. And I just think that a lot of their financials are just really rough. Like, it's just not.
Yeah.
I don't know. It's like you're gonna go public and hope to become a meme stock. Like, hey, board, our plan is to become a meme stock. Really? That's our plan? Yeah. Let's just hope we meme. If we don't meme, we're screwed. Like, I don't know.
I mean, you're right. It's public market. As a former, short seller in the past, it's a lot rougher place, the public markets, and
unforgiving. Yeah, you can't short these private companies.
Very different.
Yeah.
So it's a different skill set in some set.
Totally. Yeah. So we'll have to see. I mean, I don't know.
Well, Tyson, thank you so much for hanging out with us today, sharing your wisdom. If listeners want to connect with you or hear more about Notice in your work, where can they do that?
They can go to notice.co and hit, chat with us. There's a chat thing there. They can just contact us through email there as well, or just sign up for a free account and use the product for free. And if you have questions, you can reach out to our team, and I'm happy to talk with you too if you have deeper questions. And yeah, we just want to make sure that you have the tools you need to, to be prepared for what you're doing.
Well, perfect. I'll bring you back about an article, but I also would love to have you back in the future to look at some of these trends in the private markets versus the public markets and the valuations of privates. I think it's just fascinating. So thank you so much.
Yeah,
thank you very much. We'd love to be here.
Thanks, buddy.
Thank you, Sue. Cheers, guys. Thank you.